The following program contains views that are not those of WVTC, iNetworks Communications, their subsidiaries, affiliates, or financial supporters.
That was fast. Hey, how you doing? It's Brian Sewell, the mortgage doctor, with you, talking and having some fun, educating, encouraging, and empowering everyone with the opportunity to own a home. In this case, to keep your home comfortably and look at other options. So I'm blessed to have my friend Stephen Barnes here from our Cherry Creek Mortgage on the reverse side. How you doing, Steve?
Doing good, Brian. Thanks for having me.
Good. We are going to share a lot of things with you today. We're going to bust some myths. There's a lot of myths out there for reverses. So, and then also got my friend Ron Granada in. I don't mess up your last name still, do I? Did I hit it right?
Oh, you're perfect.
I'm perfect. I don't hear that too often. That was perfect. But one of the things that, Ron is one of the smartest people I know in the industry. I've known him for 20 plus years. Same thing with Steven. I always try to bring people on the show that can help in really educate the average consumer. You guys can jump in and ask questions. So do me a favor, share the show. We're going to jump in and talk about reverse mortgages. I think I don't know what that says at the bottom there. Am I reading something wrong, Damon? So we probably want to put Stephen Barnes from our reverse division and Ron Granada. I don't know what is that at the bottom. Cortin, I can't read. Somebody was having fun with that. But look, if you guys ever want to buy a home or refinance a home, or you want to know about reverses, the reverse mortgage, I need you guys to share the show, tune in, because you're going to be able to ask questions about this. If you're a kid that's worried about your parents potentially going to reverse, you'll be able to ask questions. So I need you to share this. We're going to wait a few minutes before we jump right in. I'm thinking about going live here on Instagram just to help out even more so, which I guess I'll have some fun with it. Why not embarrass myself? So this is going to be good, guys, because again, you hear so many things out there when it comes to reverses, right? And I don't know if you hear that. Steve, how long have you been in the business?
Been in the business 12 years now. I've been focusing predominantly on reverse mortgages. Our audience has always been folks 62 or older.
Okay.
So I would consider myself a retirement solutions mortgage provider.
Well, I like that.
We're not just forcing the issue that the reverse mortgage is the best option for everyone. We're really analyzing everyone's situation and customizing a mortgage option for their needs. More often than not, though, the reverse mortgage happens to be the best fit. So it's something that I've learned a lot about over the years, and happy to help educate everyone here.
Cool. For those that's jumping in on Instagram, I got Stephen Barnes here. Maybe I can turn it this way here so you can see everyone. Let me see. I'm having a little fun. Yeah, he's here with us. We're on WVTC Radio. If you tune into the app, you can. But we're just talking about reverse mortgages and just understanding the whole process. Again, my job is to educate. I truly believe that. We believe in coaching, educating you, encouraging, giving you the power to make a good decision. I also got my buddy Ron Granada, and then I'll set this up a little better next time. Ron, can you see yourself over here? Come a little closer. We don't bite. We're talking reverses on Instagram, and we're on Facebook. We're everywhere. So, guys, again, please share. If you have an elderly, somebody hit Lynn. I know she had reverse questions. Lynn out of Colorado. I want you to jump in. Stephen, are you from what state are you in?
Presently in Denver, Colorado.
Okay, cool. Yeah, so he's in Colorado. So I know Lynn from I got my golden doodle from her in Colorado. Yeah. So she has some questions. So just make sure if you guys have reverse questions, I got Stephen Barnes in here. We're going to talk about reverse mortgage. We're going to bust some myths. But just we have your presentation. Do you want to go straight to presenting and kind of giving that information out, or do you want to kind of just start the breeze here, just letting people know about reverse? What's your call? Your show.
Well, let's clear the air a little bit about what a reverse mortgage is. What are some things that you've heard about the reverse mortgage?
You want to hit that one, or you want me to go, Ron?
You first.
Okay. So, I mean, I know a little bit, so I'm kind of cheating, but I'm a guide to it. So I've heard that it's equity stricken, that you lose all your money, it costs too much, and if I'm a kid, I'm losing my inheritance. That's what I hear about on the street. That's what we hear. That's the thing. You're losing your money, you lose your equity, I'm going to lose my home.
Well, what I can tell you is that the program changed a heck of a lot over the years. It's slowly become a much more conservative program. And the main reason behind that is because they do want there to be plenty of equity left over for not only the estate, but also mom and dad. If they happen to live to be 85, 90, 95 years old, they need to relocate to assisted living.
Mm-hmm.
We still need there to be plenty of equity left over for them to be able to take with them to the new home. So the FHA's really refined the program to make sure that that's possible.
I heard you say something wrong. You said the FHA. So people think FHA is like, oh, wait a minute, I use that to buy. I use it to buy my first home. Mm-hmm. So what do you say to that? So it's a similar product.
All a reverse mortgage is an FHA loan, but you're not obligated to make payments.
Okay.
There's a lot of misconceptions about the product itself, and people misunderstand what it really means. It's just a regular loan option. And in this case, the FHA is the one that makes the rules. So it's going to be the governing body is the FHA. They're going to determine what the rules look like. And ultimately, they're making sure that this is something that is set up for setting up households for success and making sure that it's a sustainable option.
Love that. So when we think about reverse mortgages and just, again, you hit on a lot of things that, so if I'm a kid, it sounds like even if my parents live, you mentioned they live in the 80s, there's still the way you guys calculate things now, previous, maybe 10, 15 years ago, you can expect to potentially be able to get in and have some money left over when you go into your if you have to go into assisted living. How does that get calculated? Go right to the math. I love numbers. So everyone else, I notice when I make people do math, they leave, but I like doing that too. but seriously, hit that. I know that's a question. Like, how do you figure, if I'm 62, can I get all my money? Or the younger I am, the less that I get. Can you dig into that a little bit?
Yeah. So the older you are, the less risk there is with giving you cash. Therefore, the older ages will qualify for a little bit more money, or loan to value in our jargon. But back in 2017, the FHA did make some changes to also include interest rates into the calculation. So they wanted to ensure that if rates were high like they are today, that we weren't setting someone up for failure when it comes to eating up all that equity. So what this means is that over the course of the last 24 months, as rates have continued to rise, we've seen the loan to values drop for each and every qualifying household.
Yeah, I've seen that too. Yeah. And that's because of the rate and the risk, right, with the rates.
So because of course, if you're not making payments on an 8% loan, the loan balance is going to grow faster,
right,
than if it's at a 4% loan. So the FHA did make some positive adjustments to the program to ensure that there is going to be equity left over given normal property appreciation.
Okay. So you made a good point. So we can't guarantee that the consumer is going to refinance within a year, but we've seen a lot of buy down programs come out, right? That's how we're kind of dealing with some of these things. There's some creative programs we put together to do in a forward mortgage. I'd like to see that makes sense on the same hand. So someone that's buying a house right now, and I like to use the 1% rule. I like simple math. You buy a house, let's say your loan amount's $400,000. Generally speaking, in Illinois, it's about 1% payment. It's like $4,000 a month. And I say that because of taxes, insurance, all that type of stuff. So if you're looking at that in this market at the higher rate environment, that's eating at some of the equity that you can give out or some of the risks that you can take, is what you're saying.
Yeah, it definitely is. Really, what the reverse mortgage boils down to is that if you have a 30-year fixed interest rate today at, let's call it 8%, 7.75%, 8%, and you have a reverse mortgage rate at 7.75% or 8%, which is about where things are at, they're pretty much the same as you would see on a 30-year fixed rate. is the point here. You can choose to make payments on a reverse mortgage and pay it off in 30 years. And your payment would be exactly the same as it would be on a 30-year fixed.
So you don't have to do that. But I guess what in this case, and Ron, you can speak to this because you were the big pick a payment guy from World Savings, right, back in the day. So basically you can go into it with the flexibility as a senior and say, hey, I have the cash to make payments, but I may, there may be some months that I don't want to make payments.
Exactly.
Right.
It's a regular loan with flexibility on your payments. And I think that the best example that we can share here is someone that is still employed that may be considering retiring in a few years. Well, with their employment income, we can get them qualified for that 30-year fixed rate today.
Right.
But if that income goes down in a few years when it's time to retire, that payment might not be something that they can still afford.
Okay.
So the reverse mortgage is going to give them the flexibility to dial back on that payment without any recourse from the bank.
That's good, Steve. So guys, it's, again, Brian Sewell here, Cherry Creek Mortgage here with Ron Granada from Plymouth Title, Stephen Barnes from our reverse division, and we're just diving into the reverse. Guys, you've heard a lot of things about reverses, and I want you guys to share and jump in, ask questions. Because again, if you're a senior, if you're not even a senior, and you're thinking about eventually retiring, or if you're a kid and you got questions about your parents going to reverse, we want to hear from you. I apologize for that, guys. We want to hear from you and be able to explain. That didn't do good. Somebody calling me right on the spot, right? We want to be able to explain to you how this reverse can benefit you. So when we think about that, right? So and I'm trying to put myself into those kids that say, hey, I'm losing my inheritance, right? Which you hit on it a little bit. I want to look at the other side of it because I've heard people talk about, and I've heard other originators talk about, oh, it's just not for you, but there's no true answer, one size fits all, right? So you may have someone, and this is the things that keep me up at night, and you could speak to this more, you've done way more reverses than I have, is that if I have a senior that is struggling financially and they're sitting on a gold mine that can help them not struggle, talk about that.
Well, the first point I want to hit on there is the kids that are saying that you're taking my inheritance away from me. I mean, what we really got to ask ourselves are mom and dad in a comfortable position?
Mm-hmm.
Could it be better for mom and dad at this point? And if the kids are really worried about what they're going to inherit in the house, by all means, make a payment.
Right.
You can make a payment to preserve the equity, but it's what the reverse mortgage could do is eliminate that obligation for mom and dad and really leave the burden on the kids at that point to dictate how much of this bucket am I going to inherit later.
Right. Well, I appreciate that. So again, you're addressing it. If you wanted to, you can tap into the inheritance there. I mean, help maintain that. But also, you could also, there's insurance policy stuff that they can have in place to help offset that debt. I just think about it. So many things have happened over the last, let's call it 20 years. Even what happened with COVID, some people were positively impacted, in restaurants were negatively impacted. And so financially, it hit certain ways. There's just like when you have wars, right? There are situations where people that invest in military, they do well. A lot of us do bad, and this war is never good. But I'm saying there's situations where some seniors would have been hit harder, and I think this is just another avenue, another vehicle we could use to put them in a better financial situation. So if they start jumping in late, we have your presentation right there. If you want to start diving into that, that's your call. We can jump into that. I don't know how long it is. It's like a few minutes, or
We can flip through.
it. Okay. Damon, if you don't mind sharing some of that, and we can just talk about some of this stuff. We'll open up for questions. Guys, don't hesitate to call and jump in and ask questions and things of that nature.
Please go ahead to the next one there. Come on. So we've covered it here, Brian. Like, what is a reverse mortgage? Well, it's just a regular FHA loan, but it doesn't require payments. It was put into place by Ronald Reagan back in the day. Believe it or not, it's been around that long. And it was designed as a means to make Social Security more of a living wage.
Okay.
So what better way to make retirement more affordable than eliminating what is likely your largest expense, your mortgage, right? So that was the whole goal behind this product in the beginning, is let's eliminate what is the largest expense, the mortgage, and make retirement a little bit easier for seniors in the US. Well, we touched on this again. There's been a lot of changes. It's not the same program that it was several years ago when we started to get some bad things being said about it. Back in the day, we were giving people access to 70, 80% loan to value. And
Oof.
what happens when you don't make payments on 80% loan to value?
Yeah, you're going to be negative.
You're going to be upside down.
Right.
So the people that were screaming the loudest from the rooftops were the kids. They're saying, you're stealing my inheritance. And so the FHA came in and they decided that we're going to reassess this program. We're going to make interest rates a part of the calculation. We're going to dial back on how much people qualify for at particular ages. And now we're starting a heck of a lot less than where we were.
Oh, I've noticed that
5 years ago.
Yeah. So you had some actuaries come in and just kind of put together a more conservative plan.
Yep.
Okay.
More conservative plan. So
is it also now taking more a look at the credit worthiness of the client? Whereas
absolutely.
before,
That's a great point.
bankruptcy, is it in bankruptcy credit? Do they have enough, whether it's in some type of liquid assets, to be able to make the tax
taxes,
payments?
yeah.
The taxes, right?
Yeah.
Are they not looking at that now more so than they were before?
We are absolutely, back when I first started in this industry, even I guess it was 8, 9 years ago is when they made this change. But before that, we didn't have to look at credit. We didn't have to look at income. And what was happening is we were setting people up for failure. People were not paying the property taxes. And what happens when you don't pay your property taxes? Whether it's a reverse mortgage, a regular mortgage, or the house is free and clear, what happens?
You can lose the house.
You can lose the house.
You lose the house.
If the person buys the taxes, they could essentially push for a deed after a specified time, depending on the state. But yeah, I mean, it does happen a lot.
So people were blaming the reverse mortgage for something that really wasn't the reverse mortgage's fault.
Yeah.
And what the FHA implemented is exactly what you said. We now look at credit. We now look at income solely as a means to make sure, are they able to afford taxes and insurance at HOA? And are they reliable to pay the taxes, insurance, and HOA?
I'm going to bring you a little bit more on screen because I don't think they can see you while you're talking there. Yeah, there you go. Yeah, no, so we got to get a little closer, guys. So we're brothers here. We're okay. So look, here's the thing. You made a good point. And I always like to simplify things. There's some complexity in this, but I think that you're hitting it on the head. You're still responsible for taxes and insurance. So while you may not have to make mortgage payments, your tax and insurance have to be maintained. And, so that's one thing. Why would someone might say, why should I do a reverse? I was taught, get a job, work hard, buy your house, pay it over 30 years. We could talk about that. And then, that's my piggy bank, right? Why would I want to turn around and do a reverse mortgage?
Well, a gentleman I spoke to last night actually was in a very similar situation. Mm-hmm. He's 87 years old, I believe. He had $50,000 left in the bank. House was paid for free and clear. And I asked him the question, what if that $50,000 is exhausted?
Also, all he had left over was $50,000, nothing in retirement.
He had $50,000 left over. That was it. And he had a pretty decent income that was coming in, but that was his rainy day fund, $50,000. And I asked him, I said, well, in today's economy, how long do you think that $50,000 can last you? And he didn't really have an answer for me. He said, well, you know what? I'm going to figure out what to do when it's exhausted. Well, what I was explaining to him is that the house being free and clear is just like another account that you have access to. But he doesn't have the liquidity unless he utilizes a mortgage. And the mortgage option that he qualified for was, in fact, a reverse mortgage. So in his case, he could have had access to a line of credit for approximately $120,000 that nearly doubled what he would have access to in his present situation. I told him, well, you know what? It's not something that you may need today, but what if you live 5 years and that $50,000 is exhausted? What are you going to do then?
Aren't banks reluctant? You might not be able to answer this, Brian. If a client has not had a mortgage let's say for 10 years, they paid off their house 10 years ago. Is it not very difficult to obtain an equity line of credit because they have not had a mortgage for so long?
Well, from a lending standpoint, because we do HELOCs too, you can't discriminate because of age. And I know these rules already, but I was in CE all day yesterday, so some point they were bringing up. I don't care if you're 85 years old. I can't turn around and say you can't do a 30-year mortgage. Now, I can talk with Steve and say, hey, let's look at some options. Are you sure you want to have this type of payment? Let's maybe look at a reverse, right? But I can't legally, and if a bank tells you that, you can report it to the CFTV. We can't discriminate because of age, race. Now, to a certain extent, we can discriminate with the reverse, and that's not true. You have to be at least 62. You have to be a senior. So that's allowed. That's a different type of, that's discrimination for your benefit. You can't take out a reverse when you're 50 years old. Okay, you're still working age. I'm not saying you're not working at 70 or 80. I'm just saying that from that standpoint, the banks can't do that.
Odds are not high that you're working at 80.
No, probably not.
But if you want
Unless you're like, what's that girl, Betty White, that just passed away a few years ago? She was still kicking and screaming, right? Yeah.
But
go ahead.
many of my clients are retired when
at their 80s.
Or if they are still working, they're thinking about retiring.
Yes.
What I was saying was banks are reluctant, not a regular first mortgage, an equity line of credit.
Oh, yes. Okay.
Where the house has been paid off, banks might be reluctant to give you one if you've not had a mortgage payment for such a long time. Plus, they have to income qualify you. So if they say, well, you're on Social Security, so we're going to give you, I need $150,000 or $200,000 in cash, but you're only taking in, I don't know what it's, $1,800 in Social Security. They're going to, based on where rates are at right now on prime, we're pushing 8.5%, 9%,
Yes.
possibly higher for some people. When you calculate just their interest payment on what they draw and taxes and insurance, if they don't have a freeze on taxes, they may be at their debt to income may be too high, correct?
70%, yeah.
So then the bank they're going to have a hard time qualifying for an equity line of credit, which is usually the first option that people would tell you to do, right? Get an equity line. Well, if you can't get that, you're going to have a harder time qualifying for a first mortgage because they're going to also go look at your income.
Yeah.
They're going to be stringent on debt to income. So then what's the next option? This is where reverse would then be it's the only choice in that regard, right? It's not even.
Damon, if you could go to the next screen, we're talking just about this here. So
okay, sorry to jump ahead.
No, I like it.
Maybe the next jump one more for me. Here we go. Maybe not.
One more.
But one more, please. So, oh gosh. So the difference between the reverse mortgage and the HELOCs and the other regular mortgage options, of course, is going to wind up being that this one's going to be a lot easier to qualify for. People on fixed income more than likely are going to be running into trouble nowadays getting qualified for an 8% rate. Now, I'm not saying that every household's that way, but the large majority of folks that are on fixed income, if they do qualify, they don't want that payment, right? So the reverse mortgage is a good option to substitute the difference. We can use reverse mortgages for several different things. We can use it for houses that are free and clear.
Okay.
We can use it for houses that have an existing mortgage where we're refinancing the existing loan. Maybe there's a little bit extra that they qualify for, which would be available in a line of credit. Or we could use it to purchase homes.
I love that one. That one I've done. That makes a lot. So that one, so the purchase part, which you can spend a few minutes on that. But people probably say, why would you do a reverse? Everyone's calling me. Call the office, guys. 630-352-0629. I'm being funny. But so here's the thing. Well, that still rings on my cell too, so that doesn't make a difference. But here's the thing. And you can dive into this. I'll never forget this purchase we did for someone. They wanted to build their dream home.
Mm-hmm.
Okay. And they were like, hey, and they brought it to my attention. And to be honest with you, I didn't even know about reverses back then. I knew them, but I didn't know about the purchase side. So they were like, they had done some research on it, and they were like, look, we only make like $60,000 a year. They were accountants. They wrote off all their income. So technically they could afford a payment, but they wrote everything off, and they were 67, 68. And they said, we want to build our dream home. So they built their dream home. And let's say it was like 450, 500. They put down I want to say 40, 50%, something like that. And then they never have a mortgage payment. Perfect example. So they didn't have to qualify income-wise because they could afford the taxes and insurance, but they wasn't qualifying for the mortgage payment back then.
Even if they do qualify for the mortgage payment today, and many of these folks that are qualifying for those mortgage payments, they are employed.
Mhm.
And they're at an age where we got to ask them, what is your 5-year plan? Because if they say
That's
that
good.
they're
That's
going to
a good question.
retire in 5 years, well, what are we doing qualifying them for a fixed monthly payment that they're likely not going to be able to afford in a few years? So the reverse mortgage is a good option to consider.
Right.
I think that everyone that is of age should lay on the table a 30-year fixed rate compared to a reverse mortgage. What are the benefits and the burdens of each? And that's really where Brian and team here are going to come into the picture to help someone navigate to the appropriate decision.
And I'm leaning on Steve a lot. Like I know enough to stay dangerous, but like if I don't know the answer, I have no problem saying, Steve, help me out. So not to jump ahead, but I love what you said in the beginning of the show. You said retirement solution mortgage provider. Yes, and so dive into that a little bit more. And I remember you talking about this last time you were out. You were saying like there's situations that you may want to push back on taking Social Security, and correct me if I'm wrong, that you get more at a higher age. Like say if you're 62, if you can wait till you're 70, you'll get more, and you can use the reverse to kind of offset that retirement plan. So I'm kind of leading you a little bit, but just clarify that a little bit more.
Absolutely. So the reverse, obviously, Social Security, the longer you wait, the more you get in the benefits. 70 would be the max benefits. So if you have the ability to delay taking Social Security and you're in good health, you foresee being able to live to 80, 85, 90 years old, well, it may make more sense to liquidate some of your house equity to live for those 6 to 8 years during retirement there between the ages of 62 and 70.
Call the office.
And delay Social Security so that you get the maximum benefits later.
Right. All right, we're going to say that one more time since the being multitasking. So go over that one more time for those that was listening to my phone buzz.
So just delaying Social Security is something that we consider when looking into the reverse mortgage. We're talking to clients about their entire financial position, what their 5-year, 10-year plan looks like, whether or not their spouse is in good health. Because if their spouse passes away, well, one of the Social Security checks is going to go away.
That's true. So let's do the scenario. Well, I know you probably got some in there, but like say if somebody was making, I don't know, Social Security 2,500 each, or making this, I don't know if it's got 3,000 each, so 6,000. And let's say you have a mortgage payment in good old Illinois, taxes are high. I don't care if you do get a senior exemption, the taxes are high. That's why a lot of people move down to Florida, but Arizona. But let's just say your taxes are 10 grand a year, so $800 something a month, and you got your medical insurance, all that stuff. You a couple of bills. Maybe you decide to get your, retirement car, whatever, $500, $600 a month, and you lose half your income. Then it becomes a lot tighter.
Definitely.
So speak to that, senior.
The reverse mortgage can offer peace of mind in those scenarios. So we're talking to people about the tough conversations that ultimately need to be had with this demographic. Is what does that 5-year plan look like? If your husband were to pass away, is your wife going to be able to comfortably afford that house payment? And more often than not, people are not thinking about those scenarios. And part of our goal here at Cherry Creek and Guild Mortgage would be to help them navigate those conversations and those thoughts appropriately so that they are making educated decisions that are sustainable for the entire household.
Okay. Makes sense to me. Let's talk a little bit more. And again, are you still, I don't know if I keep moving you all around, so I apologize for that. Anything you want to go on specifically to your plan here? You want to go back a few slides or continue here?
Well, let's go back 2 slides and let's talk about who qualifies for a reverse mortgage.
Great point.
So first and foremost, reverse mortgage clients have to be 62 or older. The only state that requires both spouses to be over the age of 62 would be Texas. So in Illinois here, you're fine if one spouse is 62, the other spouse is 58. That household could still qualify. It's got to be a primary residence. And we got to make sure that they can afford taxes, insurance, and HOA. That's going to be their primary obligation with the reverse mortgage. With the loan itself, there is a financial counseling session that's included, and that's in place there as a protection, because we are working with protected age class, and we need to make sure that they spoke to someone like Brian, myself, or some of the other team members here at Guild that understand the reverse mortgage and gave them the appropriate information. But then when it comes to the house itself, it's an FHA loan like we talked about in the beginning. So it's got to be up to FHA standards, meaning that if it is a condo that we're looking at, then it has to be FHA approved.
Okay. When you say FHA standards, it's the same thing. We look at safety issues, right? So we're looking at a house or townhome. I know I tell people this all the time, is that we look for no peeling paint, cracked windows, things of that nature, right? Alarm smoke detectors and all that stuff's got to be in there. So it's nothing, and that's another myth, and it's got nothing to do with reverse. Conventional and FHA are not that. There's not a huge difference. It used to be, prior to, I would say, 08, 07, but they're very close. So, a lot of times, and then condos can be a little tricky. But no, that's good, Steve. Keep going. I got a question for you, and it's not on some of the questions we have, but this is probably something that I just want to hit consumers. And again, share the show. This is Brian Sewell, the mortgage doctor, sitting with Stephen Barnes from our reverse division in Colorado. And then also I've got my buddy Ron Granada here from Plymouth Title, trying to educate you on reverse mortgages and busting some myths on these. So share the show, guys. Again, even if you have parents that are thinking about a reverse, or if you're old enough to think about a reverse, this is ways that we can give you some affordability, comfortable retirement solutions, alternative retirement solutions. So let's say, we talked about this earlier, you're looking at the credit. Let's say somebody comes in and they're like, man, I had a little bit of a struggle. Let's go back to the example we're using. I lost my spouse. I was making $6,000 a month. I went down to $3,000. My taxes are costing me $800 something a month. My medical bills, and I only have like $500-600 left over, and my credit score is 590.
Mm-hmm.
You're not going to give me a reverse? I own my house free and clear.
Well, so the reverse mortgage itself, we're not as credit score driven as many of the other products out there. So you still would qualify for the reverse mortgage option, but in that scenario with the 590 FICO score, I would presume that there's some derogatory credit history. And
it could be in that situation, they lost their spouse, and they just, because I've seen this with some seniors, that especially if one person was taking care of all the bills and the other one wasn't, sometimes it takes them a little bit to get caught up and get comfortable. I've seen that. And we've had to help them out and things of that nature. Even without doing a reverse, he's like, hey, look, you got to talk, because they don't always have access to everything. Yeah. I've seen that in older couples. That's not always the case, but I've seen that. So it could be just a matter of, a couple credit cards they had to get. They didn't know where the money was going. They were figuring everything out, because you guys do things together, but you see it sometimes where one person's handling the majority of the bills. And
in that situation, the rules of the program nowadays would dictate that we have to collect for taxes and insurance to ensure that client would never fall delinquent on the tax.
So they wouldn't lose the house up on them from a predatory guy coming.
If they were to take money out, let's say, at cash out, a portion of that would be set aside specifically to ensure that the taxes and the insurance are paid, correct?
Correct. So it would be the reverse mortgage at its core is just a line of credit. That's really all it is. It's a home equity line of credit that doesn't require payments. If we have to reserve some of that line of credit for future taxes and insurance, that means that the borrower does not have autonomy with that portion. It can only be used for taxes and insurance. So let's say it's a $100,000 line of credit. We reserve $20,000 for future taxes and insurance. They would still have access to the remaining $80,000.
Right.
But that $20,000 is taken out whenever tax bills come due.
Okay.
Let me use a scenario on where somebody could be a good candidate, because I'd like you to kind of touch on that. We have an aging population. We have hospital medical system is extremely overwhelmed and very expensive. Mm-hmm. They say 50% of all Medicare costs in the country are paid for people in the last 6 months of their life. So it's extremely burdensome in the last 6 months. you're seeing more and more seniors that wish, rather than be put in a home, to stay at their home to live their final days. Do you see this as a good option for people that, let's say, want to get home health care and their insurance maybe it only covers a certain percentage and they have to come out of pocket for the difference?
That's a great question.
Could a reverse mortgage be a good option for those people, those seniors who wish to live their final days in their house, either can't get into a home, it's too expensive, or just they don't have the desire to for obvious reasons, they want to be comfortable? So what do you see people using that as an option? And how would you explain this, let's say, to the heirs of the estate, who, if they don't pick this option, would then be burdened with the financial responsibility of having to put them into the home or into their own house to take care of? So maybe I'd like to get your take on that.
So the proceeds can be used for whatever you see fit.
Okay.
And as you were insinuating there, that's a large portion of our demographic is concerned about final living expenses. And those that are in their early 60s with free and clear houses, sometimes they don't need the cash now. They're using it as an insurance policy for later to prep for exactly what you're speaking of. Other scenarios, we have clients who are 90 years old where we get the phone call from the power of attorney, who's the daughter or the son, and mom and dad's in-home health care is 10 grand a month. And now all of a sudden it's a burden on that family. And the house is paid for free and clear. So they're leveraging the reverse mortgage to pay for it that way as well.
I want to ask you about that. I mean, you may or may not know the answer to this. Power of attorney has to be executed when they're fully coherent,
Competent.
right? Competent.
Of
Sound mind, right?
Yeah.
So they can't take out a reverse without them being of sound mind, right?
You can, just as long as we have doctor's notes that dictate that they were of sound mind at the time that the power of attorney was written.
Right, and they're going to be in the price. So yeah, they'll be there taking care of it. So talk to me a little bit about, Ron, that was a great question, about how you can break this up. Let's just say, going back to the example, we wait till we're a little older to get some, to take out our social, and we just want to get a cash flow. So like that example where a spouse had passed away and they want to get, some cash flow. Maybe they want $3 grand a month now to offset until they hit 70 to get more of their pension or retirement, whatever.
The scenarios are going to be a bit different. We'll jump into
That's right. You have some,
scenarios
yeah.
in a second, but in scenarios with the reverse mortgage, again, it's just a line of credit. So Damon, if you could go forward a couple to the ones with the graphs. There you go. So this would be a scenario in line with what you're speaking of here.
Okay.
So house is worth $600,000. The house is free and clear. So
Okay.
there's nothing that we have to pay off at the start of the loan. In this case, the client's 70 years old. They qualify for $227,000 in total. That's a line of credit for $227,000. In this case, their options would be to either take a lump sum. They could set it up on an automatic payment plan, $3,000 a month, as Brian asked about, or they can set it up truly as an open-end line of credit and just use it as needed. If needs are that they need a lump sum, a monthly payment, and a line of credit, we can do all of it at the same time. It's just really about asking a client about the particular needs and working with the loan originator to make sure that it is set up appropriately. In this case, this client takes out $75,000 and he's left over with $152,000 line of credit. If he wanted to set it up on monthly payments for $3,000 a month, we can absolutely do so. But if you divide $152,000 by $3,000 a month, it's only going to last a certain amount of time.
Right.
So at its core, it's just a line of credit. It's just how much is left over. So Damon, if you could go to the next screen for us here, we'd see how it looks a little bit different for some households. So in this scenario, we have a mortgage that's owed against the property at $200,000. So the first thing we have to do with the $227,000 that they qualify for is pay off the existing mortgage for $200,000. So in this case, they're eliminating their monthly mortgage payment that would have been on that $200,000 loan, but they're left over with $27,000. Probably not going to set up the $27,000 on $3,000 a month payment because it's only going to last a couple months.
Right.
So it is a case-by-case thing, and it depends on whether or not there is a mortgage owed against the house when we're talking about monthly payment distributions.
Hey, Franklin. Hey, Ramon. Thanks for jumping in on the show. Again, guys, I'm here with Stephen Barnes and Ron Granada, Plaintiff Title, here with Steve Barnes from our Cherry Creek, our reverse division. And so can we go back one screen real quick and just, and I know they had a mortgage, but I want to just just hit back one more. So touching on this green, and the bad thing right now, Stephen, is that the rates have gone up, right? Well, the good thing is we're sitting at all-time equity. There's a lot of people sitting on a ton of equity. And I want to just bring, you didn't know I was going to say this. There's people that are thinking about either downsizing or they want to move to Florida. But they're like, man, if I sell my house, I'll make a lot, but that rate's going to be a pain in the butt, right? It costs me more to sell. So let's use this example right here. And we're just kind of talking out a little bit, which, I love putting people on the spot. So get to know me a little bit. So let's say I'm in this situation and I'm like, all right, I'm tired of Chicago or Illinois, tired of paying all these taxes, doggone politicians. So I want to move to Florida and I want to buy me $600,000 house. Okay. But I don't know if I want this 7.5%, 8% interest rate. And we're not talking rich. We're just saying, this guy owns this house free and clear. So what I would normally do if the house is worth $600,000, I'd sell the house, pay my realtor costs, and then I'll have to probably take some money out of my checking and savings account and add like 30, 40 grand to it and go buy my house free and clear in Florida.
Yeah.
So tell me what options I have, other alternative options I have.
Well,
and I'm doing that because I don't want to pay the 7.75 rate.
Of course. And so that, for most folks, it limits what their buying power is, because they're in many cases looking to buy in a newer community that's 55 plus, or maybe moving closer to the kids and grandkids that live in a more desirable area. Or the scenario that we had just a couple months ago, lady was moving from Missouri to San Diego, California. Price points are going to be completely different in Missouri versus San Diego. So she was selling her house for $200,000, and you're not going to find anything in San Diego for that. So she leveraged the reverse mortgage to purchase a house, a small little condo in East San Diego, where she was able to get in. Now, let's just use this as an example here. This gentleman, he was 70. His one option for him was to do the reverse mortgage and get a line of credit for $227,000. Well, the other option would be if he sold his house. Okay. So if he sold his house, let's say that he pays real estate commission fees, $35,000, $40,000. So he's going to net $560,000 out of the sale of this home. So Damon, if you could go a couple slides forward, one more, there we go. So he netted $540,000 out of the sale of that house, and he wants to move down to Florida. Well, he can absolutely go buy a house for $500,000 in Florida with all cash, but he's going to be left over with $40,000 after moving expenses, probably going to be a wash. Right.
So he's sitting at zero. So he has no, he's got a nice house, but he's like kind of a little tight.
What am I going to do?
Right.
In the event of an emergency, what am I going to do if the AC needs to be replaced? AC is going to be running pretty strong down there in Florida in the summer months, I assume.
Absolutely.
So what his options would look like with the reverse mortgage, using it to purchase, he could get into that same $500,000 house where if he paid all cash, he has nothing left over in the bank. Or he can leverage the reverse mortgage where we're giving him $205,000 as a qualifying funds towards the purchase price. And instead of coming up with all $540,000 that he netted from the sale of his $600,000 house, he's only having to come in with $316,000.
Ooh, I like that. So he's left with a couple $100,000 left over.
So now
220, something like that.
He accomplishes the same thing as an all cash purchase, which is no mortgage payment. Right? That's the main reason why he wanted to pay cash, is because he didn't want a mortgage payment.
Right. Or he didn't want to pay the higher.
But now he keeps the liquidity of having those extra funds.
Keeps the cash in the bank so that he has something in reserve in the event for emergencies.
So then that's where asking the clients the right question: what is your goal here? I don't want a mortgage payment. And this is where this option would come up.
Absolutely.
As opposed to, I want to leave a legacy. I got to leave a house. I want to make sure my kids get a maximum equity when I sell. If that's not the main concern, if that's not the main motivation, then this has to be brought on the table 100 times out of 100, don't you think?
I'm a big fan of telling everyone, realtors included, that we're doing our clients a disservice if we're not talking to them about this.
So do you think that a lot of the suspicion has less to do with perceptions and misconceptions, or is it just the fact that their lack of exposure to the product itself is what's leading to the misconceptions? Because what I don't know, I naturally won't trust.
Yep.
So we don't talk about it enough in the industry. So that's by itself, we're telling them it's a scary product because we don't talk about it enough. We try to keep it quiet, under wraps, or just avoid a conversation altogether. Do you think that could be playing into this whole, where we have to now walk everything back and say, no, this is a good product, this is safe, but the reason why as industry professionals have not used this as a viable option when talking to clients, specifically those in their later years?
Is lack of education, not only within the consumer demographic that qualifies here, but also within the industry.
Yes, that's what's going to get at.
There's a lot of loan professionals that don't care to learn about this option. When, it took Brian and I a couple times sitting down together for him to really grasp this, and a light bulb went off in your head. You said, wow,
Yeah, makes sense.
This is an option that could be leveraged for many households, and to put them in a sustainable solution. We're doing a better thing for this household by considering this as an option.
I want to piggyback on that because I want you to expand more on that. So I'm going to talk about it from a consumer and from a loan officer. I've been doing this for 22 years. So I used to have a bad perception of them. And, it was not until I saw how you can help. You see, we're taught, and I'm probably saying the same thing over and over again. We are taught. You go to school, you get your degree, you work hard, and my mind opened up about that is just being an entrepreneur, right? So I changed that mindset at 21, but you do all this work and you work your tail off, you turn 62, and then you're like, what now? Right. So I think that no, it's not going to be for everyone, but I think what Steven is saying is that you're doing a disservice. You're not talking about this to your parents. You're not talking about this to your clients because you don't understand something is bad. I showed Steven something earlier today, and I'm not going to say names, but we were, someone that's in the profession, right? That's, this counseling people that's saying, hey, no, this is bad for you. Just because someone took advantage of you or took advantage of some senior, and you guys know the story in Illinois, this guy, I'm not going to mention his name, that he took advantage, he went equity stripping, him and an agent was taking money from seniors, but not giving it to they were manipulating the reverse, and they were taking cash and keeping it in their pockets. What the guy was telling, you give me the money, which they don't, and I'll put it in an investment, and he was never doing it. And so there's a big thing. So just because there's bad pastors, there's good pastors, there's bad lenders, there's good lenders. We're here to actually help, and we're going to take the time. You're going to go through counseling, right?
Go through the counseling, yeah.
Right. Yeah. So this is where it's, oh, that's bad. I'm not going to do it. But you're
right. I wound up in prison, right?
Yes, he did. But he got out of it. But what's funny about him, and he actually, someone in his family opened up another mortgage company, and he's like an originator. Like, it's weird how it is now. You can look him up. I'll tell you about it off here. You can look him up and see. And I think you know who I'm talking about too. So it's, so here at the end of the day, because you got to fight it, but you need to do your research. Don't trust this. There's all kind of scams and people trying to attack seniors and elderly. But one thing that kind of bugs me, though, there's a couple of things that bug me. And I'm going on. I talk about building wealth all the time on the show, guys. You hear me? I show the screen. We'll talk about this. How buying a house, you build equity. But there's times you can leverage your house once you built all that equity to put you in a better financial situation. One of the things that gets under my skin is if I see a senior that's 55, 60 something years old, and they have no money. So we didn't talk about building
and the kids aren't helping them.
And the kids, right, that bothers me.
And their house is free and clear.
Right. That's, use what you can. This is how you can live a good life. Live out, you shouldn't have to struggle. All your life. You struggle to work and put your kids through that stuff. So, why can't we use this product to help you live good?
It's just another asset,
right?
The reverse mortgage is just a means to access it. Just like a home equity line of credit is a means to access it.
Right.
So the the product itself got a bad reputation in the past because of a lot of misunderstandings of how the product works.
Mhm.
And Devon, if you could go back a few different slides, I want to talk to you a little bit about some of the things that I hear on a daily basis from clients. Keep going. One more maybe. There you go. So some of the common misunderstandings that I get on a daily basis when speaking to clients on the phone is that, like Brian said before, that program caused me to lose all my equity. Well, it's not the same program it was in the past.
Right.
Right. Or I don't want to sell my house for half of what it's worth. It's just a mortgage. You're not selling your house.
Right.
Right. It's just a lien that we're putting on title. You owe back whatever the balance is at the time that you go to sell or the estate goes to sell, which takes us to our next point that comes up almost every conversation. I want my kids to still inherit my home. The reverse mortgage makes that impossible. Well, did you know that a reverse mortgage is probably a better fit for most of the kids that inherit the house? And the reason
Yeah.
Because they give you a time period, do they not?
the reason I say this is because with a regular mortgage, you best believe that service provider is going to expect you to continue making the payments after mom and dad are gone.
That's a good point.
If you miss that first payment, you're in default alone. If you miss 3 more payments, in most states,
Foreclosure
you're in
proceedings.
foreclosure.
Yeah.
So with the reverse mortgage, the kids have 6 months from the date of the death of the last surviving spouse to decide, what do I want to do with the house? Do I want to keep it or do I want to sell it? Their options are the same as a regular mortgage. But during those 6 months, they're not obligated to make monthly payments. So from my perspective, I think it's actually better.
It's not taking 6 months to sell a house right now. I mean, each market is different, guys. A house is not enough inventory. So, I mean, you're moving on, or you can decide I want to keep it. The kids have the right to buy it too, right?
They can keep it by just calling up Brian and refinancing the note for whatever the balance is.
Right.
Now, you raised a good point. In this market, things are moving quick. But if there were to be a market after mom and dad are gone where things are sitting for 6 to 12
Say it's the
months,
2008 market, yeah.
well, as long as they call us up at Guild Mortgage, we service these reverse mortgages. As long as they call us and say, hey, the house is listed, we understand that we have to settle the debt, they can get granted extensions to a total of 1 year from the date of mom and dad's passing.
Okay. So we're working with them.
We absolutely.
And that's a good point too. I mean, that's really cool. Is that we keep 90% of our mortgages, and then the reverse we keep all of them. So when you think about that, you're not going out to ABC Mortgage across the country. This is a company that's been around for a long time, and
take a lot of pride in our customer service.
100%.
And that's the primary reason we do that.
Yeah. So, guys, if you guys got questions, jump in. We usually get a little bit more feedback. You're making Steven scared. I'll mess with you. So, share the show. I hope I don't have this on private, but share the show. But, and a lot of times it's listened to later. But, we're trying to help you, leverage an asset as another retirement option. I love what you said. What was the exact word you used? Retirement solution mortgage provider.
That's what I told every one of my team members when they joined the team. That's what they were.
Okay.
So
Retirement solution mortgage providers.
Yep.
That's good.
We're looking at the whole picture. We're not financial planners. We can't do that, but we're putting our FP cap on in a sense and looking at the whole thing and customizing a plan that makes the most sense for that household.
Yeah, makes sense. So look, we're gonna bust a couple of myths. You got a couple of things on there. Time consuming and costly. What do you say to that one?
Well, that's actually directed more so at the realtors and the loan originators here in the room. A lot of the loan originators might have some false impressions as to how long these loans take or how difficult they may be to get to the finish line. On average, right now, our turn times on these are anywhere on purchases, 15 to 20 days. On the refis, we're about 20 to 30 days. We did a purchase last month in 12 days from start to finish.
Nice.
So I would beg to differ for anyone that says that these are time consuming. But now the costly piece to the puzzle, it's an FHA loan. If you look at a VA loan with funding fees, if you look at a regular FHA loan, they're more costly than normal loans. Now that's just
Because those are essentially assurance products.
Yep.
That's how they're self-funded. That's how the rates are low. That's how the guidelines are aggressive. It's because there is an insurance policy attached to it that makes sure that those loans stay solvent. This wouldn't be any different, correct?
This wouldn't be any different. That I would say that the primary reason they charge so much for this from the FHA is because there's no other program like it.
Yeah.
What other program doesn't require a payment?
I want to ask you about that if we have a couple of minutes. We got like 5 minutes left. What are the advantages of a paid-for home that was left to the only child that is near retirement age? So I guess they're saying the retirement age of this kid is like, say they're like 61, 62, and this house, I guess the parents are gone, and they have a house that's paid off. So you can speak to that.
Were the advantages of a paid-for home that was left to an only child that is.
So what advantage would they have? But they're 62, I guess. So they're near retirement age.
It's a free and clear property.
Right.
So it was left to a child. So now it is.
So they do a reverse.
They're the heir.
Yeah.
And then
once they become a retirement age.
So the advantages of doing a reverse mortgage versus not doing a mortgage at all is what we're asking here.
Right, I guess. So should they just leave a house that's paid off to go to retirement age, or like all those examples we gave earlier, they have the benefits of those, right? So I don't know how you want to answer that.
Well, I would assume that we need to ask mom and dad who own the house and who have worked their entire lives to get that equity in the house. Is this something that are they going to need access to that equity at some point? We shouldn't be concerned about inheritance and the kids and what they're going to get out of the home. If mom and dad can live more comfortably because they leverage a reverse mortgage product and now the house is no longer free and clear, then in my opinion, it's a better fit.
Better fit, yeah. I mean, it's just about living your life comfortably, man. I'm just gonna say this. Look, we want the American dream of home ownership. We want to live. I think some of that building wealth to me, just having more than enough, right? But being able to travel, see the world. I mean, Ron, you do a lot of that, I know. But just being able to see the world and be comfortable, not be house poor. The parents are deceased. The only child's near retirement. Okay, good point. So yeah, I thought that's where they were going. So they're saying that they're about to retire and their mom and dad left them a house, but their parents are gone.
And their option, I'm assuming, is to occupy the house full time. That's why this is
primary residence. So
they'd
have to move there.
They would have to move there. So then the question is, now they live there. It's a free and clear property.
They're almost retirement age.
They are, but are they going to need access to cash themselves? I think that's what they might be getting to. These folks are going to need to cash for themselves. So then the options would be, if they're near retirement, what would be their options to get access to that cash other than selling the home?
Mm-hmm.
Possibly an equity line, a mortgage if they can qualify based on their retirement income, or these would be the three options, right? A reverse mortgage.
Yeah, I mean the first two require payments.
Correct.
The reverse mortgage doesn't require payment. And if you want to compare this to a home equity line of credit, which is one of these points here that I have people call me up and say, I think that the home equity line of credit is a better fit. Well, in my opinion, it's not, because one, it requires a payment. After 10 years, it's going to come full term and your payments are going to triple.
Well, because it's going to be 20 years, right?
And beyond that, the whole regular HELOCs, they're not guaranteed. They can be frozen or taken away overnight without any explanation from the bank.
The bank just says, I don't want to do them no more.
There's people that have gone 15 days late on those equity lines of credit instead of 30 days late. They've had those shut down because it falls under a different, you're not regular residential rules. It kind of falls under more commercial, where, like you said, they can treat it like a credit card. Oh,
you done.
You didn't pay out your grace
cut
period.
off.
You're cut off.
You're
not
cut
30,
off.
15. So your credit's still clean, but now you don't have access to this.
Right, and your credit score is going to go down because now they took away your limit. If you're
now your limit's been raised. This is
right.
true.
Yeah, that's a good point.
So the reverse mortgage is a guaranteed line of credit. As long as it's available, you're occupying the property as a primary residence, and you're paying your taxes on time, it's not going to go anywhere.
Guys, this has been fun, man. This show went by so fast. And again, we get a lot of good information, Steve. I appreciate you for jumping on. Stephen Barnes, our reverse division. Ron Granada with Plymouth Title. Guys, if you got any questions and you want to talk about this further, we're not going to rush you, but if you get it, call us, give us an opportunity to help you. My number is 630-352-0629, 630-352-0629. I think we have a couple of spots open available if you want to jump by Blissful Banana Cafe. We'll be talking a little bit more about this tomorrow in Royal Park. As an agent, you need to learn about this. Come see us. We love to help you, love to be your lender of choice. Again, we'll see you next week. God bless.
Views made on the preceding program are not those of WVTC Radio, iNetworks Communications, or their financial supporters.
Winning victory through Christ. WVTC Allsip Chicago.